Based on the type of investments you make, whether it's sale-leasebacks here or abroad, I guess it's a two-part question. But you have to be interest rate sensitive when you're making long-term sale-leaseback investments. And then similarly, when you invest abroad, you're to some extent, I believe, taking some currency risk. So when you become a REIT, the question is, how do you hedge against the potential, even though we don't see it today, for a rising interest rate market?
Well, the currency question is easier, and that's something that we still focus on every day. And in the past, what we've done is use costly collars, so that, for instance, in the euro, we're some 90% hedged in one of our portfolios against the euro, and 80% in one of the earlier portfolios. And the way that works is simply that we sell a call, recognizing that the euro is unlikely in the near term, we think, to go above 142. We sold calls at 142, and with the proceeds we purchased puts at 140, so that we're locked in for 3 years on a substantial part of our euro cash flow. So the other way that we would handle that is in any other markets to bake in wherever we can that same sort of a swap, so that we fix the US dollar return, because we are dividend payers. That's an incredibly important part of what we do. What we provide for our investors is dividend income that grows with inflation. With respect to the interest rate question, that's a lot harder, obviously, to hedge. What we try to do is we take non-recourse debt, particularly when we go abroad, wherever we can get it, because the non-recourse debt, we see that as the most natural hedge when we're buying. We're long foreign currency. When you borrow, you're obviously short, so you reverse it, and it's just a natural hedge against the currency. We take fixed rate debt for as long as we can get it. Right now, we do have some exposure, some 5 to 7 years out. That's unhedged, and it's something that we manage actively. It's sort of something that we do in conjunction with, generally, with our asset recycling, and so it's something that we're constantly aware of. And I would say that what we do is just try to stay on top of things. And but I think there's some risk for everyone who uses debt that rates will go up. The question is when will the end of this great sort of bond bull market be? Nobody has a crystal ball, but I think that there's quite a lot of exposure generally in the real estate world. It's not just as pertains to Europe or Asia or the US. I mean, I think that eventually rates will rise. What we try to do is not so much hedge for it actively, but to bake into our assumptions when we do a deal some amount of rate increase, whether it's 100 basis points, 150 basis points. It really kind of depends on the deal. But